After a long and slow recovery, the U.S. economy finally picked up steam in 2015. The unemployment rate dropped to 5%. The annual growth rate topped 2%, and the Federal Reserve bumped interest rates for the first time since 2006. But for investors, it's been a mixed bag. For more, I'm joined by Jason Howell, President and Family Wealth Advisor at Jason Howell Company. All right, Jason, 2015 marked the end of free money. Why did the Fed finally raise interest rates, and where will those rates go in 2016?
Well, gosh, it was about time. We've been predicting this, we being the general financial industry professionals, for a long time, and recognize what the Fed is trying to do. They're trying to recognize the economy and how well it's done over the past few years. We do have a growth rate of 2.5%. Unemployment is below 6%. So recognizing that, it wanted to create some bandwidth in case the economy dipped again by increasing interest rates, which is rates between banks, which effectively are our rates. It's giving us bandwidth to say if something happens like 2008, the Federal Reserve can do something.
The stock market was largely flat in 2015, tethered to the price of oil. Will our 401ks do any better in 2016? I hope so.
Well, the proper answer is it depends.
Yeah.
It always depends on what you're in. So effectively looking at the indices from this past year, most of the market was flat, whether it was the Dow Jones Industrial Average, the S&P 500. But depending on your sector, if you were in tech or something else, you might have done very well. If you were in energy, you may have done pretty poorly. So it always depends on a couple of things. Number one, what's the goal of your money? Number two, what's the strategy? And number three, what are the tactics you're going to employ to make sure you get what you need for your money?
Why does Wall Street think low oil prices are a bad sign? They're so used to thinking that if oil prices are low, that means growth around the world is doing poorly. That's not the case. It's a bonus for us to have low oil prices, but Wall Street cannot disconnect from thinking that low oil prices mean a bad economy. What's the problem here?
Well, I agree with you in a couple ways, Morris. I love having gas at less than $2 a gallon. I never thought I'd see that again.
Yeah, right.
The challenge is a lot of the oil that's in our country and in other places is not cheap oil anymore. You have to drill, you have to frack, you have to kind of go in diagonally. So if it's expensive to get that oil needs to be expensive per barrel to make a profit.
Right.
And so in these days, oil is less than $60 a barrel, and so there's not a lot of profit, which is bad for the overall energy sector.
And it's having a poor, the Texas, Oklahoma, some oil states and San Diego are not doing too well, layoffs, so I know that's bad news for them. All right, we saw several mega mergers in 2015, like Kraft Heinz, Pfizer, Allergan, and Dow DuPont. What should we take away from all that consolidation?
Well, look at it this way. Money was cheap this past year. It's gotten a tiny bit more expensive, and it's predicted to get a little bit more expensive next year. Should we see more mergers? Tough to say that there will be as many. Maybe people will be running around and saying we need to get more mergers while money is still as cheap as it is. The important factor for you and I is how does this affect us? As companies get bigger, they get a little bit more control, and it gets more challenging to predict which way companies are going to go. For you and I, again, it's goals, it's strategy, and it's tactics regarding our market and our goals for our money.
Jason, your industry is also buzzing about the possible impact of the fiduciary rule. Tell us more.
You know, for 100 years, Morris, when you talked about financial advisors, it was about selling you a product, whether it was insurance and annuities or just investments in stocks. In 1974, we had ERISA, which was a law around our retirement accounts that said this to employers. The money that your people are saving in retirement accounts needs to be good, needs to be not too expensive, so as far as funds, there needs to be options. Now we're in 2016 and everyone's rolling money over. All the Department of Labor rule is saying, when you roll that money over, there needs to be options and the funds need not be too expensive. It's going to be a boon really for advisors, but especially for the public to say, now I really can trust what my money is doing and where it's going if folks have to take a legal standard in being on my side.
Before you go, give our viewers a tip. Where is this smart money going to be invested in 2016? And as they watch, it's already 2016 in some parts. So what's your advice?
My advice is the same three things I mentioned before, Morris. Number one, sit back and say, what is this money for? If it's for something really serious like your retirement, then be really serious about that money and look towards the indices to get the least cost for your funds, for your money. That's number one. You can predict how much you're going to pay. You can't predict what the market's going to do. Number two, look at your strategy, and if you have to work with an independent financial advisor to do that, then all the better. Someone who's going to be on your side of the ledger when it comes to investing. That'll be wonderful. And then be really careful with your behavior. And again, that's why some folks work with outside professionals, because it's kind of hard to operate on yourself. So work with someone who's going to be on your side and help sort of stop you in case you react too much to a lot of volatility that there will be in 2016.
Jason Howell, President and Family Wealth Advisor at Jason Howell Company. Jason, thanks. Good luck to all of us in 2016.
Thank you, Morris.